Whatever you do, don't sell these two Vanguard funds. They're both actively managed too. Oh my goodness, actively managed funds. So I was talking to a guy, working with a guy the other day, and he had a prime cap fund inside his 401k, Vanguard prime cap in his 401k. Was it in his 401k? No, is I can't remember. He had a Vanguard Prime Cap. I don't think it was his 401k. It might have been a brokerage account with a active fund manager. I can't remember where he had it. I forgot. But I said, man, hold that puppy. Hold that puppy because it's closed to new investors. I don't think they've opened Prime Cap for a long time. And the fund just has been a dominant fund for decades, man. Will that continue to be? I have no clue. But the facts are the track record is spectacular. You don't want to, lose that fund. It's crushing. Now the baby of Prime Cap is another fund called Capital Opportunity, and they introduced this right when I started at Vanguard in '97, something like that, '98. They introduced Capital Opportunity at the latter part of 1996 because they had already closed Prime Cap back then. Vanguard did. Because Vanguard knows if you have too much money in a fund, it can't do well. And the reason it can't do well is because it becomes a closet index fund. That's what happened to Fidelity Magellan. When Peter Lynch was running it, they were making money hand over fist. Of course, they had no money. No one knew who he was. And so then the money just started flowing in. After that, it just didn't do anything. It just became a closet index fund, which charges a high fee. You're not going to make any money relative to the market with that. Anyway, so if you have access to, and I'm going to go into both these funds, Capital Opportunity and Prime Cap, you better hold those puppies, man. And that means keeping your 401k. If you have it inside a brokerage account or an IRA that's being managed by a guy, just transfer in kind. Whatever you do, don't sell this thing. Obviously, if it's an inconvenience inside your 401k, for whatever reason, get rid of it. But I'm just saying, generally speaking, if you can keep the funds, you should. All right, so first thing we're going to look at Vanguard Capital Opportunity, close to new investors, mid-growth, the growth. So I was like, well, that's probably why we'll go into this stuff here. Expense ratio is 43 basis points. You just can't shake a stick at that. I'm not sure what the size of the fund is, but they close these funds. Let's see, in terms of how much the assets are. I don't know. We'll go into the performance here in just a second. I want to see the asset base here. One sec. Right, look at this, 18 billion. That's tiny for a mutual fund. I mean, I know it's a lot of money for you and I grant you, but for a mutual fund that has done so well, that's big fat nothing burger. Look at that, 18 billion, man. Fund management, Prime Cap. Oh, look at that, huh? All right, so now we see that one right there. Let's go to the Prime Cap now. Here's Prime Cap large growth. So Capital Opportunity is mid growth. Prime Cap is large growth. The growth side of things makes me nervous because growth is torn it up. But I'm going to share with you some history. You're like, wow, that's pretty impressive. Expense ratio is 38 basis points. I mean, who manages it? Prime Cap Management Company. Look at those guys. All right, so let's keep going here. How big is this fund? So Capital Opportunity is 18 billion. This is 64 billion, but it's been around for a lot longer. 20 years? I think it was incepted in 1984, 1985, something like that. I'm curious what their turnover is. How many trades do they make? Let's see here. All right, so remember I talked about Closet Index. This only has 171 stocks in it with a benchmark of 500. So this is a third the size of the benchmark. That's, look at the turnover rate, 3.1%, man. That's what you're looking for. At 3.1%, they buy and they hold a smallish selection of stocks that they just hold on for dear life. Let's see about Capital Opportunity. We got about 45% of the benchmark. A little bit more stocks than I would like actually, but the performance is what it is. I'll tell you right. Turnover here, I bet it's low. Yeah, 6.3%. I mean, they just buy and hold. I mean, they hold on for dear life. That's freaking nuts, man. I mean, that's nuts. All right, so let's go to Portfolio Visualizer. And we're just going to go back to, basically, I'll show you the full range of the returns on both these guys. Again, Capital Opportunity started in 1996, if memory serves. And so this will just take us back to 1996. January 1996 to December 2022. We got prime cap, we got the S&P 500, and we got capital opportunity. Prime cap had a compounded annual growth rate of 11.44. Capital opportunity 12.17. S&P 500 basically 9. All right, so you're like, yeah, because it took a lot more risk. Really? The worst year for prime cap was 32% in 2008. Worst year for the S&P 500 was 37% in 2008 and 39% for capital opportunity. The worst drawdown, S&P 500 had the worst drawdown. That's crazy. I mean, it's crazy. Standard deviation, yes, is more volatile, but not much more. I mean, 17 to 15 to 19, or basically 20. That just look, capital opportunity. I was up 1 year, 97%. That nuts. I mean, just look at that, dudes. So if you look at, let's not do log here. I want to show you. So look at the difference. $10,000 invested in S&P 500 went to $100,000. Whatever, how that's 20 years, 25 years later. Yeah, about 25 years later. 222 in capital opportunity and 186 in prime cap. So here's S&P, here's prime cap, blue, and yellow is capital opportunity. We log it. All right, so here's logged. It just makes it look more, narrowed, refracted, or constricted, I guess, whatever. But I mean, look at that, man. And then you go inflation adjusted. But I mean, that's just prime cap has smoked S&P 500. Is no other way around that, and the capital opportunity has too, without much more downside risk. Look, the downside risk was worse for the S&P 500 than it was for prime cap. Man, it's crazy, nuts. And they were like, well, it's got to be because of the growth stuff. I said, okay, let's narrow these around. Go up here. We'll go to 2000. So we'll show you what happened during the heavy growth phase, 1999, when growth was tearing up, and we'll see the S&P 500 probably underperformed. I think probably pretty significantly. So look, capital opportunity started low until about 1998, then it took off. But still, for those 5 years, 96 to 99, or 4 years, S&P 500, they're all pretty tracking. All right, now let's go into the next 2000 and 2003 when the growth stocks got hammered. All right, so S&P 500 compared to the other two, and growth stocks got hammered, boink. And let's see what these guys did there. Look at that. S&P 500 did the worst of the three when the growth stocks got hammered, man. Prime cap was only lost 6%. Capital opportunity was up 15%. It's crazy. What the hell's that about? S&P 500 did the worst in those 3 years. It's nuts. So let's go 2007 to 2009. I can't, literally, this shocks me. I just talked to this guy. I said, I should do a video on this. And I said, let me also do it. Capital opportunity. I was like, whoa, 2007 to 2009, S&P 500 did worse too. I'm sitting there thinking, what the hell is happening? So let's go to 2010 to 2022. Just crazy. All right, 2010 to 2022. And there we go. They're all kind of tracking. Let's see, 2010 to 2022. Again, S&P 500 does worse. Was worse downside risk. It's nuts. In terms of worst year, drawdown's all about the same. And I said, okay, let's just go to 2022 when the dividend stuff, the value stuff did better. Let's take a look, shall we? And then we'll see 2022. And the S&P 500 did worse. What's the V? Let me change out S&P 500 and put VUSVX. Is that what it is? VUS Vanguard Value Fund. Hold on a sec. Compared to VIVAX, which is the Vanguard Value Index, that is essentially their version, the mutual fund version of VTV. All right, so 2022, the Value Index did better than both Capital Opportunity, significantly better than both Capital Opportunity and the Prime Cap. All right, so there you go. So there's a feather in our cap. All right, so let's go to 2010 to 2022. And I would imagine Value did worse than those two guys. Let's take a look. And it did, yeah. So Value averaged 11.33. Both of those averaged 12.5. to 12.69. So prime cap has done better than capital opportunity over the last 10 or so years, but still pretty significantly pretty close all in all. All right, so now let's go to 2000 to 2003. Actually, let's go to 1996. We'll start from there to 1999, where the growth stuff did well and the value stuff got spanked. So let's see here. Spanked. Didn't do as well. I hate to say spanked. It didn't get spanked. All right, so here we got, so look at that. Even value. I mean, that makes sense. Value should have done worse than the growth in those 3 years, 4 years. All right, so now let's go to 2000 to 2003. And I would think in this case, the value did better, if not much better, than the growth-oriented prime cap and capital opportunity, I would think. Here, let's take a gander. And no, look at that cap op. Man, that's nuts. That's nuts. And prime cap and value were pretty much tugging along there. All right, so let's go to 2007 to 2009, because the only people really care about is the downside. And that's what happened 2007, 8, 9. And value did work, because that's where the dividend stocks and the banks were. Crazy. All right, let's just go to the last decade. Or the last, from 2000 to 2022 since inception. Since end of last year. Yeah, look at that, dude. That's freaking nuts. Value is 6.82. Growth, prime cap was 8.47. Capital opportunity is 9.55. Worst year. Value had the worst year of prime cap, and capital opportunity had the worst year of all three, but capital opportunity average had much, much higher than the best year. The max drawdown, value had the worst max drawdown. I'm just stunned by that. Now, would you put everything? No, you got to have some value offset, because what if this is the decade of the value and these stocks might not do as well? And if you got these in your 401k, don't sell them, man. I'm telling you, find a way to transfer them to your IRA, or get them out of actively managed, because these are just kick butt funds, man. No other way around that. Should you put everything in there? Just to reiterate, no, you can't, and you can't buy them anyway. So you don't want to. You can add to it, you just can't buy it as a individual investor. I love your thoughts. Don't forget to subscribe to Doobly Duke and follow me on Locals. Both are in the Doobly Duke down there. See ya.